everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Brett Swarts, is a founder of capital gain tax solutions. Each year, he equips hundreds of business professionals with Deferred Sales Trust tour to help their high net worth clients solve capital gain tax deferral limitations. His experience includes numerous deferred sales trust, Delaware statutory trust, 1031 exchanges, and 350 millions in closed commercial DST and the CRE brokerage transactions. He is an active Sacramento multifamily broker and the investor with a brokerage experience and ownership in multifamily, senior housing, retail, medical office, and mixed-use properties. He's licensed to California real estate broker and has held the Series 22 and 63 licenses. Quite a bit resume. Thank you so much for joining our show today, Brett.
Elisa, my pleasure to be here. Looking forward to adding some value to you and your listeners.
Awesome. So I was wondering, so we always start our show as one question, which is growing up, who shaped you the most in terms of the entrepreneur who you are today?
Yeah, growing up, I would say who shaped me the most to be the entrepreneur I am today would have to be my cousin Nick and my dad. You know, they're both entrepreneurial in their own right, and thought outside the box, and didn't want a limitation on the income they could make, and also wanted the freedom to kind of be their own boss, if you will. And so they taught me the kind of the sticks and bricks of real estate, as well as the brokerage side of real estate and investing and communication and sales. And so combined, both forces would be the most influential for me.
Yeah, that's awesome. And Brett, how did you get into the niche area of capital gain tax solutions?
Right. So I started out at a young age in real estate, learning about, rentals and cash flow and development in the Bay Area, California, and fell in love with real estate. And so I thought it would maybe do that in the future. And so I went to college and got a couple degrees and, played basketball in college and wanted to be in something competitive. And so I got into a brokerage with a company called Marcus & Millichap, where we studied and practiced multifamily investment sales, buy side, sell side, and helping people add value and increase revenue and drive out NOI and ultimately sell for a higher price. And so we learned 1031 exchanges and capital gains tax deferral in that scenario. But it wasn't always easy. It was 2006 and things were going really well. And then something happened. It was 2008, the crash hit. And we went from making, a lot of us in the Sacramento office, making, a good amount to like almost nothing overnight. And part of it was because transactions stopped. And also clients were in a tough position because they were fighting for their properties as well. And that began the assessment of what was going wrong. And what was going wrong was too many people were using the 1031 exchange as their only option that they knew of to overpay for properties, take on too much debt, and not have enough liquidity. And so I saw some friends, family, and clients lose half or everything over the next couple of years. And in the meantime, I'm newly married, baby at home, and my wife and I are figuring out a way to keep the lights on and the food on the table, and also her full time with our baby. And so I got a side hustle at a place called Cheesecake Factory, and by day I'd make cold calls at Marcus & Millichap with banks and them, and nights I'd work at the restaurant. And I did that for a couple years. But I learned about the Deferred Sales Trust during this time period because of the pain of that time. The pain was I wanted to make it in the business, is also the pain was I wanted to solve problems for clients. And those two things combined, my manager at Marcus & Millichap brought in a gentleman to speak on the Deferred Sales Trust. And that was the beginning of getting into capital gains tax deferral. Fast forward, we now teach and train people how to do this across the nation. We close about a deal a week for high net worth clients. We also train CPAs. We train financial advisors, commercial real estate brokers, syndicators, crypto experts on how to do this. And I was able to retire from the Cheesecake Factory. My wife and I have 5 kids, and she's been home full time with our kids, which has been really big value of ours. So that's kind of the story.
That's awesome. That's awesome. And so I am, we do real estate and, we're very familiar with 1031 exchanges, but what are the other strategy as other than the 1031 exchanges? Like you mentioned, a couple of different persona here, which is all very interesting in terms of, can you tell us a little bit more about the Deferred Sales Trusts or the Delaware statutory trust specifically?
Yes. So first you've got to know what tax code you're working with. And when it comes to the Delaware statutory trust or traditional 1031 exchange, that's IRC section 1031. So I like to categorize those as the blockbuster way to exit plan. And I don't know if you remember Elisa showing up on a Friday night and there was a video that there was a new release and it's behind that cardboard box and you're walking down the blockbuster aisle and you're about to get that movie, but someone steps in front of you and grabs that movie. And or you're like, oh, you're bummed out. You get the second movie, but then you don't return it within 3 days. And you have to drive there. You have to park. You have to, you're in Seattle, so it's raining. And rain's getting everywhere. And you're like, oh my gosh, what am I going to do here? And then you get the fee. I mean, that's like the 1031 exchange. Oftentimes it can be very restrictive and very challenging for people to make sense of deals, especially given where the marketplace is right now. Low inventory, low cap rates, and not a lot of value add opportunities. And so the 1031 exchange is like Blockbuster because you have that 45-day window to identify, 180 days to close. And we call that the shotgun wedding, right? And people are running around with their hair on fire. And then they're overpaying for properties that they don't necessarily want to buy. They're letting the tax tail wag the investment dog. And that puts them in a tough spot. Also, the 1031 exchange is like Blockbuster because it doesn't work for anything outside of investment real estate. It doesn't work for cryptocurrency. It doesn't work for businesses. It doesn't work for dentists or veterinarians or optometrists or tech entrepreneurs. It doesn't work for public or private stock. It doesn't work for high-end primary homes. Okay. And so you're looking at something that's very restrictive and only exclusive to investment real estate. The next thing is it doesn't allow you to diversify your investments. In other words, all your eggs have to stay in one vehicle. Now, I'm a believer and I love multifamily investment real estate. It's where my family and I have made the most of our wealth and where we believe the future of long-term wealth building is, as long as mobile home parks, also senior housing, assisted living. However, we also believe in something called optimal timing, which is enter the Deferred Sales Trust, which is like Netflix. And I want you to imagine never having to overpay for a property ever again, never having to go into equal or greater debt ever again, never having to buy something in a shotgun wedding, and being able to diversify your investments across multiple asset types: stocks, bonds, mutual funds, hard money lending, ground up development, dollar cost average into multiple syndications, do your own deals whenever you want. And the story for me that really changed this was we call it the Monday morning quarterback story. And it was a gentleman in 2006, and he used the Deferred Sales Trust for the first time. Now, this guy hates the stock market, loves commercial real estate. At the time, he's worth a couple $100 million, and he's selling a $20 million property across the street or nearby the Minnesota Vikings Stadium. And it's a commercial real estate property. And he's looking around for his 1031 binoculars and he's going, is there anything out there? Nothing's out there. He goes, this doesn't make any sense. And he had a sense that the market was at its peak. Okay. And so he said, I'm either going to pay the tax or I'm going to take a chance on this deferred sales trust because I'm going to defer all this tax. And so he steps out of the traditional Blockbuster. He jumps into the deferred sales trust Netflix thinking that it could help him. And it did. It helped him in a big way. He's able to diversify all of his equity, pay off all of his debt, and then defer millions of dollars of tax and sit in a safe, we call it the safe harbor, in the bank and also in the stock market. Now, he put in conservative stuff, so it wasn't subject to the huge crash of what happened in 2008. In fact, so much so that he played it perfectly in that 5 years later, the bank calls him up and says, hey, you know that property you sold to that 1031 exchange buyer out of California? And he said, yeah. Well, we just foreclosed on him and we're just curious. Do you want to buy it back from us? He goes, well, maybe. What's the price? And the bank said 60 cents on the dollar for what you paid for it. And he goes, that sounds like a pretty good deal. He goes, give me a couple days. He was able to reallocate the investments out of securities into an LLC to purchase it with him at a 40% discount, all tax deferred, not using a 1031 exchange. This is my part where my brain exploded. I'm going, oh my gosh, like if this is real and legit and has been tested and proven, which is the next most important question we can cover here in a minute, but this will change everything. This is Netflix. This is no longer Blockbuster exit planning. And so that's where we're on a mission to do this. Like you don't have to put it into the 1031 timelines. You don't have to go to equal greater debt. You can buy low. You can sell high and buy low. You can diversify your investments. It works for cryptocurrency in that you can exit crypto and then you can go buy real estate. You can exit real estate and go buy crypto. And it's just incredible opportunity for people that are looking for something other than the Blockbuster 1031.
So how does you mentioned about the legal side of it, like how come like we never heard about these magical vehicles? Because we have investors that comes to us all the time thinking about, hey, I don't want to do 1031 exchange anymore, but also some of them want to just do passive investing. But like part of the reason is that you can get the tax defers in syndications and etc. to use for it. But how does this vehicle work into the whole overall strategy over there?
Yeah, let's talk about why you maybe never heard of it, and then let's talk about also the kind of the overall strategy, how it actually works. Okay.
Mm-hmm.
So part of why you've never heard of it is because you haven't met us and our team, to be honest. Like at some point, I didn't know about a 1031 exchange.
Yeah.
And then we had at Marcus and Millichap, a person come in and talk about the 1031 exchange.
Yeah.
And then they tell us about it. And even then I'm like, well, that sounds a little bit odd. And wow, there's a lot of rules to follow. And, you know, you got to work with the accommodator. You got to do these things. And at some point we didn't know about a 401k or an IRA. Right.
Mm-hmm.
And then somebody told us about it. And then we had other people do it. So now there's been thousands of closes, billions under management, over a dozen no change IRS audits. It's been 26-year track record. So it's all happening. It's just the people you're working with don't know how to do it, or they've heard of it, but they either get it confused with the Delaware Statutory Trust, which, by the way, it's just another form of a 1031 exchange, except you're giving up all control to an operator for 7 to 10 years, illiquid, huge fees. I've done Delaware Statutory Trust. They have their place, especially for mortgage over basis, but they're just another, like a Hollywood video to the Blockbuster, and they're basically passive deals. So that's part of it. It's just you haven't met us and you haven't worked with us. And then number two, I would say for those who are skeptical, and there's a lot of people who are just relying on their CPAs to do their exit planning, or to give them a thumbs up on the 1031 or the Delaware Statutory Trust or opportunity zones. And then the Deferred Sales Trust comes up and they go, well, I've never done it. I haven't heard of it. So they're cautious. And so what happens is sometimes they can get scared. They can feel like maybe they're doing something that's not 100% legal, which is 100% legal. And they're doing something that maybe it's going to be an audit risk, which is not an audit risk. It's very low. But a story for that, I always like to say we can give people those evidence, but I want to give you guys a story to give you some confidence. And because it's one thing for me to say it, and I'm a commercial real estate investor, broker. Obviously, I sell the Deferred Sales Trust and I love it. But it's one thing for me to say it, but it's another thing for some of the best world-class financial advisors to say it. In fact, there's a story that I like to tell you from a gentleman named Bill Gross and David Young. And some of you may not know who Bill Gross is or David Young, but Bill Gross ran with David Young, and they built a company with about 5 other guys and a bunch of other people as well. But these are like the leaders of it. PIMCO, and PIMCO is one of the largest money managers in the history of like the last 30 years of management. And for them, they built that company from 80 billion to 1.2 trillion dollars. And they manage some of the biggest wealth in the world. And you can imagine a lot of people approach them with their strategies and wanting them to sell their thing. And they're very skeptical of a lot of things. Well, about 15 years ago, they all get a big payday. They all retire. And then David and 4 other guys form a group called Anfield Capital, and they're out of Irvine, California. And they collectively look at the Deferred Sales Trust. And they don't do a 2-day due diligence or a 2-week or a 2-month. They do a 2-year due diligence on the Deferred Sales Trust. They keep an open mind, and they have their legal team go and look at it, and they fly back and they sit down and they sign the NDAs and walk through all of the details of how it all works. And they came through with 2 conclusions. Here's number one. Number one, that might be the smartest person we've ever met. And that's my business partner. He's a tax attorney, and he's brilliant. And number 2, we're all in. We will put our name on it. We'll become a part of the DST Inner Circle, and we'll become a part of the advisory team for any Deferred Sales Trust client that wants us to support the financial advisor that we work with thousands of financial advisors across the nation too. And so I always say to people who are skeptical, and you should be, because this is something new that you haven't heard of before perhaps, right? 2 questions. Number 1, if it's good enough for David Young and his legal team, after 2 years of due diligence, and these are world-class economists, financial advisors, financial planners that had done extensive due diligence, they put their name on this, right? Is it good enough for me, Elisa, and whoever's listening to this podcast, right? And their legal team. That's number 1. And then number 2, are you willing to have your CPA or whoever it is come to the table and learn about it? And honestly, 9 out of 10 times if they come, they join us. But we don't give away our secrets, right? Like Steve Jobs wouldn't give away his iPhone to somebody else. We don't give away what we have. It's proprietary, it's protected, and there's one law firm that's doing it. There's not 5,000 law firms doing it, like a CRT, right? There's one. There's not 5,000 QI companies that are doing it. Like there's one, and that's really the answer, Lisa. That makes sense.
Got it. Makes sense. So how would technically this work? Let's use a couple scenarios. Let's say you're doing cryptocurrency, like you mentioned before. I mean, crypto is the hottest discussion that's out there, but when you're kind of looking through the markets right now, it's a little bit volatile with crypto. I don't invest in crypto, but I think there's some potentials over there. So for someone who's like, hey, you know what, we got a great run, made 1,000x increase on this, which is possible in crypto, and I want to diversify some into real estate, but I can't find a project yet, or I want diversify between passive investment as well active stuff? How do I do that?
Great question. So step one is you form a trust and you get with our team and you it's all conditional, by the way. You sign a conditional engagement agreement, and that allows us to form a trust, get it set up prior to the exit of the cryptocurrency or the business or the real estate. In fact, we just closed a cryptocurrency deal for a client. They were selling some Ethereum. They bought it for 100,000 and some Bitcoin mixed, and it went to about 13.5 million.
Yeah.
And they're living in the Bay Area. He's working in a big tech company. She's an attorney, and they're like, you know what? We want to exit. Now, by the way, this journey was a wild journey. It wasn't just 100,000 to 13 million overnight. It was like a 6-year journey of just, blood, sweat, and tears, if you will, on looking at the crash and the ups and the crash and the up.
Yeah.
And the reason they didn't sell is because of the tax. And so they call us up and they're like, hey, Brett, if you and your team can solve this, like we're in working with the financial advisor as well that I work with at a San Francisco. She's amazing. And we're all working. We're like, if you can solve this, we can solve this. Like we're ready to exit. We're ready to diversify. We want to go buy potentially a cabin on Lake Tahoe. We want to retire from our day job. We want stability versus the highs and lows of Ethereum and Bitcoin. So I said, yeah, what's the steps? Well, step one is we actually form a trust. Step two, we open up a trust account at Kraken. We use Kraken as our main one. Step three, they actually transfer the Bitcoin and the Ethereum to the trust account. And then the trust actually sells it to cash. And the note holder, which in this scenario, they become the lender. This is what's happening. His name is Peter. He lent the money to the trust. In this scenario, we exited 5 million within an hour. And Ethereum hit about 3,000. That was his exit price to exit. And so that's kind of the basic mechanics. The smoke clears, the trust bought and sold for the same price, 5 million. They received it for 5, they sold it for 5. So that has no tax. And the note holder, they receive a promissory note. They lent 100% of the 5 million to the trust. Transfer the Ethereum and the Bitcoin for a $5 million promissory note. And this is why this works. This is an installment sale. And as long as we follow those guidelines, they're in a deferral state. And at which point the funds can be invested, stocks, bonds, mutual funds, or again, real estate back into crypto. And they get back to them. The goal is that original 5 million plus an additional 8% rate of return. And that's really kind of it. That's kind of how it works. And then they just pay tax on what they receive. When they receive it, they can pass it to their kids and keep it going. But it's not uncommon. I mean, people do installment sales all the time. Like you might own an apartment complex for 10 million, no basis, no debt. You could carry paper for the buyer, right? You could say, hey, look, you give me 3 million down. I'll finance you 7. I'll pay tax on the 3. But you'll slowly pay me that 7 back over time, and then I'll pay tax on that. You could also do 100% financing, right, if you wanted to, but you would never do that in a regular deal because they have no skin in the game. But in this scenario, you don't mind doing it because the collateral and the trust can be secured against some of the biggest companies in the world. It could be in Netflix, Google, Apple, Costco. It can go back into your own multifamily deals or passively into other deals with partners. It can go back into crypto. So hopefully that's making some sense.
Yeah, definitely. Yeah, I'm kind of like start coming around it. It's still obviously very big in my head. And so in this case, when I'm using this trust to buy, then decided to buy multifamily because let's say, or passively invest into multifamily, how then would you execute that? Does your share still kind of held in the trust, or does your ownership held in the trust, or is there another way to kind of come out of it, or is there a need to come out of it?
Let me tell you another client deal story. His name is Shay Pope, and he did a podcast, and we did a joint breakout conference at the Best Ever Conference with Joe Fairless, with Dan Hanford and a couple others, and we had a whole panel. Okay, so he sold a business for $2.6 million in Alabama, and he had zero basis. He deferred hundreds of thousands of dollars of tax, and his goal was to go build multifamily projects. In fact, he was building a 72 multifamily unit in Tennessee. And so step one is get the funds into the trust. Step two is to identify that business venture, which was the real estate. Step three was to form an LLC. Then the trust can invest with you actively or passively into in this scenario it was active, so some of the funds went into the LLC, and then LLC was used to help build the project and invest in the bigger LLC. And so there's some details in between, but that's really it. It's just a silent partner with you. Like we call it the go fund yourself, right? You can go get money from a lender or another investor, but I could partner with the trust that owes me the money. that I would have paid to the
Right.
government anyways
Right.
and build the project. Like that's really cool, right? So that's how that would work. And the same thing could be done for crypto, whatever you're exiting, a business, a primary home. We did a $8.3 million primary residence in Palo Alto. I know places like Bellevue and other high-end areas near Seattle are going to have owners that have lived there for a long time, but they feel trapped because they have a huge tax. They cannot do a 1031, whereas the deferred sales trust can do that. By the way, the deferred sales trust can also save a failed 1031 exchange.
Okay.
This is really important for those that are listening, that you have a backup plan. It doesn't have to take one of the identification pieces, and it can save it as long as you're working with us and the accommodators that actually want you to know about this. There's a lot of accommodators who don't want you to know about this.
Right.
There's brokers who don't want you to know about this because they want to keep you in the 1031 commission thing. But which is totally cool if you can find a deal that makes sense and they earn their commission. I'm still a broker. I still do 1031 exchanges.
Yeah.
It's not always the most sense of that. So those are some of the reasons why you'd use a deferred sales trust.
That's awesome. So let's say someone is always doing the 1031 exchanges. For one or the other reason due to markets and whatnot. And then let's say one of our growth plan is to 10x our investors' wealth. By doing so, 1031 exchange is one of our strategy to do so. But in between, we get investor asking us all the time, like, hey, what happens at the end of when you 10x this self? What's your plan? Obviously our plan was like, well, we're going to go build a Class A buildings and put it on the 5% yield, and then we cash out, refi. That being said, could the trust be a possible alternatives for projects like that?
Yeah, great question. So first we want to define the problem. The problem is somewhere between 25 to 50% in capital gains tax and depreciation recapture on the exit of these assets, okay?
Yeah.
And so at a certain point, a lot of syndicators that we work with, either not all of the entity wants to move. In other words, like a third of the investors want to get cashed out, and the other 2/3 want to move, and that can create a problem. In fact, we just did it for a commercial real estate syndicator. I think it's over $50 million now worth of real estate and 4 different projects, multifamily, where they took their GP positions and they exited, and one of their LPs also did it as well, into their own individual trust. So the deferred sales trust is like Netflix in that the whole partnership entity doesn't have to move. In a 1031 exchange, the whole entity has to move. Okay. And so we can separate, and people can either pay their tax or do a trust. Okay. So that's now our minimum is $1 million net proceeds, $1 million gain, by the way. Very important to see who qualifies. We don't do smaller deals unless you have 2 at 500 each that you can combine in a short period of time. The reason is because of the cost, and it has to be a home run for you, and a good deal for us. And so that's kind of where we have those minimums. But to answer your question, again, 1031s are great if you can make them work and all of the partners want to go. But at a certain point, you do want to separate, and then it's just a mathematical equation.
Party always come to the end, right? So
how much in tax am I going to pay, right? And then what does that look like? Also with ours, you get a brand new depreciation schedule, okay? Because if you own multifamily for 27 and a half years, you fully depreciate. Or if you do some cost seg, you decelerate that. And when you do a 1031, the depreciation schedule travels, whereas the deferred sales trust, you can get a new one. If you're active in the partnership with the trust, there's some caveats, and you only get 80% of that, the way we set up the structure. So it's not a perfect silver bullet for everything, but that's why we at Capital Gains Tax Solutions will compare the 1031 exchange, opportunity zones, charitable remainder trust, and then the deferred sales trust. Also, the deferred sales trust tends to be the most of the silver bullet for what our clients are looking to accomplish, because right now the largest wealth transfer in the history of the planet's happening. It's our parents, Elisa. They're the baby boomers, and they have over $32 trillion of assets that they're looking to pass to us, the millennials. But or the next generation, but they're just looking at like huge tax if they exit these properties, primary homes, businesses, investment real estate. Those 3 asset classes represent 50% of the total net worth of America. And every day about 10,000 baby boomers are turning 65, and there's 77 million in the US alone. So you combine all of this perfect storm of all of these assets that they want to trade, but they have this huge tax. And so they're not looking necessarily to get into new toilets, new trash, new liability, especially in a marketplace that's absolutely insane when it comes to cap rates being in the 3s and the 4s and lack of value add deals and interest rates going higher and people wanting to have diversification and not have a lot of debt, right? Right now, debt is not your friend if you're overpaying for a property. Debt can be your friend if the property makes sense, but just be very careful with that. And this is where we provide so many solutions for people, as well as estate tax, okay? The Deferred Sales Trust can eliminate 40% of the death tax for ultra high net worth clients, which is an added benefit that the 1031 can never do.
Yeah, that's awesome. Now, tell me a little bit more about, thanks for touching on estate tax. Tell me a little bit more about how this vehicle can be used for kind of estate tax, because the interesting question over here is like, there's always an end to the deals. You decided not to do this, right? Or you decided to take a break, a long break, or you decide to take a short break, or you decided I'm out, like, there's enough for the legacy and my kids don't want to take that over. So in these scenarios, how does this kind of plays in the strategy with estate taxes?
Yeah, in fact, it's the most important question. How does the Deferred Sales Trust basically eliminate estate tax on ultra high net worth clients?
Like eliminate,
portfolio?
Not defer, right?
Yeah, literally eliminate. Yeah, it takes it outside the taxable estate. So the Deferred Sales Trust takes funds outside the taxable estate, but basically changing the characteristic of what it is. So you can either get a stepped up basis, which is ownership, or depending on how we structure it with what we call our DST 2.0, you can change your characteristic. You won't get the stepped up basis, but you will move all of your funds in equity outside the taxable estate. So first, define the problem. What's the problem? Well, if you're worth $22 million or more married, and any of that's inside your taxable estate, you're going to be hit with a 40% death tax, or 12 million single, although that's set to cut in half in 2025 to about 12 million married, 6 million single, potentially even lower. So the idea is to get it outside the taxable estate. The challenge is most people can't gift enough, can't buy enough life insurance, and it's really expensive life insurance, or give it all away to charity. With the Deferred Sales Trust, in one day, in one transaction, we can move all the funds outside the taxable estate, which eliminates the 40% death tax, okay? Because it's outside the taxable estate. As far as the how-to, you got to sign NDAs. We go through all of that in detail, but it's been audited, it's been tested. One of the biggest deals is the $125 million deal in San Diego that it was done for. We just did one for a $25 million client out of Colorado, sold a multifamily property. And so, you just get connected with us, capitalgainstaxsolutions.com, to learn more.
Awesome. That I learned so much, Brett, from this session. And thank you for sharing. How does people find more about it? You kind of mentioned it before. Where do people kind of reach out to you?
Yeah, well, first thing I want to point out my book that's coming out. It's called Building a Tax-Deferred Exit Strategy, and it's the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or your clients. And they always say to get in the room with really smart people. And so I got into a book with really smart people, including people like Joe Fairless, people like Kevin Bupp, people like David Young. But the one I'm most excited about is a gentleman named Kevin Harrington. And if you've ever seen the show Shark Tank, he's in the show. Okay. And so everyone's sharing a little bit about their situation with tax and highly appreciated assets. And we're weaving in the Deferred Sales Trust as a way to solve those challenges. And so, go to capitalgainstaxsolutions.com to check all of this out. You can join our free DST Deferred Sales Trust masterclass or mastermind. It happens every Friday at 10 a.m. Pacific time, 1 p.m. Eastern. You can also download our free ebook. And then you can also go to YouTube. We have a ton of content, a ton of playlists on how to save a failed 1031 exchange, this versus the 1031 exchange, how to use it for cryptocurrency, all of it. It's all there. You just go to YouTube and search Capital Gains Tax Solutions.
That's awesome. Well, thank you so much, Brett, for your time today. This is really eye-opening, and I for sure will be scheduling time with Brett after this. And really great to have you on your show.
Awesome. Thanks, Elisa. My pleasure. Talk to you soon.
Awesome. And this wraps up another episode of 10,000 Roads to Financial Independence. Thank you so much.